All right, welcome. Today we're here to talk with Susan Richards, co-founder and managing partner at Number Crunch. Thanks for joining today, Susan.
Thanks. This is fun.
Yeah, so it's today we're here to talk about financial planning for business owners during a time of uncertainty. Going into, a lot of people are starting to plan for 2021. So I guess
hmm
going in, how do you even create a plan when you don't know what the economy is going to be like? You don't know what the COVID-19 situation is going to be like. Can you, I guess, tell our listeners kind of how they should be planning their financials for 2021?
I sure can. And the first thing is, I think more than ever, people feel like they have an excuse not to plan because there's so much uncertainty. But it's times like this you really do need to lay it down because emotionally we shift a lot during the day between all the different elements that COVID throws at us. So the more that you can put your plan down on paper and then try to stick to it for a period of time, that certainly would set you up to hit your goals. And so I'll start with goals actually. So the first thing is to identify what it is you're even trying to do. Most people overestimate what they can do in a year, underestimate what they can do in 10. So I tend to encourage business owners to have an aspirational endpoint that they're going to hit sometime into the future. And think about that for a minute before they lay out a realistic target for themselves for the next year. And that might want to be broken down quarterly because we're segment by segment since COVID hit here in March. I'm in this mindset now that the September to December timeframe is a good planning segment for laying out a year of 2021, which what we know about 2021 is going to probably have as much uncertainty as we had this year. So the key things are laying out your plan over a time frame. I always recommend monthly. So starting with your revenue targets and breaking everything down on how you plan to hit those revenue targets, working backwards from a number of assumptions.
Okay, so you're kind of saying break it out quarterly, and because you're not going to know what the end of the year is going to look like, sort of thing, and kind of adjust. Would you suggest adjusting that plan based on how you're doing, or what are your thoughts there?
So I would say it's much like if you're driving your car and you miss your exit, you don't stop going where you're going. You still maintain the destination that you're headed to, but you'll catch the next exit. So constantly recalibrating. You may get to your goal sooner than planned. Keep going, and you may get to your goal a little slower, but that's okay. You'll eventually get there. So if you're setting your goal, I generally think that a company should kind of keep a leeway of expecting it may take 2 years or it may take a year and a half to hit those targets. Um, Reset them, recalibrate, I think on a quarterly basis, certainly review them on a quarterly basis so that you can see, are they close enough that I will keep the same plan or do I need to change something in my assumption? So for instance, if you are planning to hire a few salespeople in order to scale your business and you assume your salespeople can close 50 deals a month, and a month goes by and really they close 10, well, time to revisit that plan to see if it still makes sense. You don't necessarily want to keep going with the same assumptions that you set at the beginning of the year.
Okay, and you get into a great topic here, I guess, kind of measuring against your plan. Can you expand on, how do you've set the plan, this is where you think you're going to be. What tips do you have for, I guess, measuring against that plan is your actual performance?
Well, so what for setting the plan, if you're an existing business, you're already operating, then my recommendation is you export your accounting data. And so I think it's great to just create a report in your accounting software that will do a monthly P&L, at least for this year to date. So let's say your year end is December 31st. Well, you have a bulk of a year right now. You've got, January to September in there, as long as your bookkeeping's up to date, which I hope it is. And then I would also project that out for 2 years. So let's say January 2019 out to December 2022. You create a report in your accounting software for that P&L. You can export it, and then that sets the foundation in Excel for building out your budget. So that would be a key recommendation. Once you're done of the exercise, so you're going to add in, where are your investments happening? Are you hiring some people? Are you spending some money on marketing? Are you, what's your assumption around your revenue increases? Once you've updated the forward-looking numbers to reflect how you intend the business to perform, then you can import that information into your accounting software. And on a monthly basis, you can generate a report that will be your budget versus actual. So very efficiently, you'll be able to measure your progress on a monthly basis. And then you can sit down on a quarterly. Swings can happen month to month, but on a quarterly basis, take a look. How did we do this quarter in comparison to what we had planned?
Oh, nice. Yes, very thoughtful. What about cash flow? Cash flow is going to be a big issue, I guess, especially in twenty twenty
Yes.
one for a lot of companies. Some of the subsidies and that sort of thing. Can you speak to cash flow? I guess tips.
Absolutely, and it's trickier than ever. So thank goodness the Canadian government stepped in and has provided tremendous support to businesses. The wage subsidy being the most material. Well, the CEBA loan for $40,000 has been very helpful too. To anybody that doesn't know, that program's been extended. So if you didn't think you qualified, you may qualify now when you relook at the terms. However, the CEBA loan, the wage subsidy, we call it SAAS or however you want to, it's the Canadian Emergency Wage Subsidy, so CEWS. It was providing 75% subsidy of wages for qualifying companies from a March to June timeframe if you had a revenue drop of 30%. For the rest of the year, it's a percentage of, it's a multiple essentially of your revenue decline. So if you had a 10% revenue decline, you're going to get a lower percentage. For those businesses that have been tremendously hit, like the bricks and mortar, they could be getting up to an 85% subsidy. But this subsidy is declining rapidly. The government is, I think they were intending to see businesses wean from it. We now know from the throne speech that it's going to extend into June of or summer, I should say, that they've said of 2021. But we don't know what the math will look like there. So the key thing is that now, in order to estimate how much subsidy you're going to receive, you really have to project what your revenues will be. It's not a simple calculation. It's very complex. It has multiple variables in it. So you probably have to turn to your accountant even to help you. But it's an area to factor in. So don't assume if you've been receiving the wage subsidy that you're going to continue to receive it at the same rate that you have historically. I would also take into consideration your client base and how they are continuing to be impacted by COVID. They may have been paying their bills in a timely fashion, and maybe they're not going to be able to continue at that rate. So just ensuring you have enough cash reserve to be able to weather that potential risk of not as much coming in from clients. And also look to your spend to see, that critical versus needs versus wants, that sort of thing, so that you can really prioritize who has to be paid first in the event that you do have a shortfall for a temporary period.
Nice. Yeah. Well, yeah, cash flow is always big.
It is.
And I'll just take one step back again in terms of measuring. There's companies like, let's say, SaaS companies, for example, where they operate slightly different from an accounting standpoint in kind of metrics that they have. Can you touch quickly, I guess, because I know you have a big SaaS following as well,
Yes.
just on kind of SaaS metrics?
Sure. Yeah, the SaaS business model is not, let's just say that traditional financial statements do not measure the performance of a SaaS business very effectively. I'm waiting for the accounting industry to catch up. In the meantime, the industry has adapted a number of metrics that help demonstrate performance. And the key unit of measure is MRR, which is monthly recurring revenue. That's a key number that any SaaS company needs to be obsessed with. And the strength of the financials are really your ability to grow that monthly recurring revenue rapidly. So investors, for example, are looking to see a 10% month over month growth. So rapid new deals need to be closed all the time. They're looking to see low churn. That means you have less of your customer base dropping off and your MRR declining as a result of that. The other thing you want to be looking for is expansion MRR. So you're getting a customer in the door and then being able to grow the revenue. So increasing license fees that they're paying, perhaps turning on more features, things like that. And you want those expansion to essentially cover any contraction or any churn numbers that you have. So there's a lot around the revenue, more revenue obsessed than any other business model, because the profitability is calculated differently there. What these businesses are doing, they're investing in the product itself. So it's a bunch of R&D work that has to be done. And then you're adding licensed users so that the long tail, the profitability is far out, but has an exponential return. So investors love to see that. As a result, there's this metric ratio called lifetime value to cost of acquiring a customer. So that's LTV to CAC. And investors are looking to see that you've essentially taking on a lifetime value of at least 3 times what your cost of acquiring that customer is. And so your accounting team can calculate these metrics for you quite efficiently. These metrics have definitions. They're not defined and monitored by like an accounting society or anything, so they do vary. But there's fairly consistent practices in industry. And if you are dealing with a financial expert that has a portfolio of SaaS companies, they'll be able to assure you of the confidence of those calculations being right. But you do want to measure them. If you don't measure them, you'll have no idea if you're building a business that is going to be of interest to investors. And this business model requires a lot of cash to scale. So investor performance is really important, more so than a service-based business that and can continue to grow on its own with just profitable growth, just through the revenues that your customers pay. In SaaS businesses, that is less likely.
Yeah, you touched on a couple great things there. You talked about scaling as well as what investors want to see. Let's start with scaling. What tips, I mean, 2021, a lot of companies rolled back, or sorry, 2020, a lot of companies rolled back. 2021, a lot of companies are going to want to try to scale again and get back on that growth train. What tips do you have for companies looking to scale in 2021?
I would say experiment and sequence. So really break that plan that you have, that growth plan, down into little segments to first prove out milestones. So I would say companies now, with the uncertainty, can with some exceptions, but overall are probably going to be less bullish. So they're probably not going to hit full speed growth mode on 5 initiatives. You may not do your direct channel at the same time that you're going to, or your direct sales at the same time you're going to execute on a channel strategy. So I would seek, especially on the customer acquisition side, definitely exceptions. However, I'd start first with closing the direct sales. See how quickly you can close business to, and this is if you're a business to business kind of SaaS company. Add those licenses first, get that repeatable process so that when you add the next salesperson, they're able to close those deals as well. It's not so much personality based, it's really just process based. Get those processes really down. Once you've nailed that, then you're in a much better position to be able to execute on a channel strategy, which is where your big growth numbers are going to come from. But executing on all 3 of these channel or strategies, like channel, direct, early on at the same time, could leave all starved for cash. Essentially, cash is oxygen to business. And if you have, if you run out of that oxygen tank, you're in big trouble, especially in uncertain times like this, because we can't predict how bankers are going to respond. We can't predict our investors, how they're being impacted inside their portfolio. Everything just has another layer of uncertainty on it right now.
Oh, of course. And you mentioned bankers and investors quite a bit. So when you're going to investors, or you're going to the bank and trying to, get some money, what what are they looking for from a financial standpoint?
Great question. And this is, I think, where a lot of people get tripped up, that they're not looking for the same thing. So investors are looking for returns. They want to be putting their money in. They want to know that their money's going to come out. They want a strong multiple. I mean, we talk a lot about like a 10x. If you're thinking about bringing an investor in, if they give you $1 million, you're going to be returning $10 million to them. You got to think like that. You got to be thinking that you're going to be scaling your business to the point where cutting them a check for $10 million feels good because you've obviously afforded yourself the ability to do that. On the banker side, a banker's more, there'll be a key sentence that they say that they don't fund losses. And if you're, for instance, a SaaS business, well, your expenses for arguably many years will exceed your revenues. That is a loss. If your revenues are less than your expenses, your business is in a loss position in the eyes of anybody reading your financial statements, and certainly in the eyes of the bank. So the banks, there's a few different viewpoints here. First of all, we've got in Canada the Business Development Bank of Canada, BDC, and they fund all kinds of different structures of business, and they will put startup money in, which is essentially a loan that's based on the credit history of the founders. So it's a business loan. It's tied to your business. Your business has to pay it back, but it's guaranteed personally. And therefore, they will take on the risk of lending to your company before it hits profitability. In that case, you can get a startup loan fairly easily if you have a solid business plan and a good, solid personal credit history. As you scale that business, they still will look to see that what they want to fund is the growth. So if you want to work with a bank and you want that bank to continue to support your business, you have to be aware of your profitability. And for a SaaS business, it would be wise to iterate your financial plan so that you reach EBITDA positive within 18 months of each initiative that you're doing. So if you're going to take on and build out some features and spend $100,000, then you're forecasting out when you can increase your revenues to the point where you hit break even, and use 18 months. And I'm getting a little technical here probably for the listeners, but the key thing is it being intentional about profitability when you're speaking to a bank. You want to talk to them about how quickly you're going to be profitable, because they want to know that you're going to be generating enough money to be able to pay back that loan. And when you're talking to investors, it's about a big market play and being able to scale the company. Think in terms of $100 million business. That's the investor mindset that you want to take on.
Oh, that's great. And in terms of investors or banks, even diversifying their portfolios and investing in different types of companies, I know diversity has been a hot topic, especially more recently. What are they looking for from like a team makeup, or does diversity play into what they're looking for? Can you speak on that?
Well, I think diversity is going to be a hot topic for the next decade. We've seen a lot of discussion about it in 2020. It's been a long time coming. I think the business case for diversity is well established, and I believe in the market. People really understand the importance of our communities having equal opportunities for people of all backgrounds, so that we can all succeed and prosper as a community. And I think within organizations, decision making by people that have the same perspective is not quality decision making. Diverse perspectives allow us to think of new ideas, think of better ideas, think of more efficient processes, better customer experiences. The more you have quality, diverse discussions, the better performance your business will have, hands down. And you can't get there unless you have diverse people around the table. And so I think what we're at now is that there's an understanding that, yes, we want diversity. I think a lot of organizations feel a bit of shame about where they're at today. And they're eager to improve that. It's the wave that we have to do now as a society is making sure everybody understands how. What are the actionable items that we can do in order to improve that diversity? I anticipate the government will be setting some form of quota or guideline or rule or something on this. We are seeing it more so out of the United States. In some facets, there are organizations that have to meet certain standards when it comes to their procurement, that they need to buy from women, or they need to buy from organizations that have a diverse workforce. So it's starting to be something that you can earn points from, and that's driving some change. We don't have as much of that here in Canada, but I think that will be coming, and I also think Canadians are eager to do actionable items once they figure out what those are. And so that's, I think, that where we're at in this journey right now.
Nice. And are there any, I guess, quick or actionable items that people can start implementing today to help? Because I mean, you can't just grow your diversity overnight, right? How does a company get started?
Absolutely. I think the focus for me, so there's two elements of it. There's hiring a more diverse team, and then there's ensuring that they feel inclusive. So there's the retention. You need to set goals on either side. You want to make sure that anybody that you do hire that has a diverse background has the same retention rate as those that are not as diverse. That is what proves out that they feel, it's one of the metrics that can help ensure that they feel included. But for the hiring standpoint, it's actually some pretty bold moves that need to be happening because we're so far behind, especially in, let's say, the tech sector, which we have such a large element of here in our nation's capital. In order to improve let's say, the amount of women or visible minorities on your executive team, management team, your R&D team, you pretty much have to, let's say you want to increase it by 30%. That probably means that at least 50% of your new hires need to be diverse. Just think about that. The first complaint that I hear is that, well, nobody's applying. Right away in our job postings, we are doing things that are ruling out certain people from applying. So if I was to talk about gender, women need to feel more confident about the role before they'll apply. They need to have done the role before. And I've got a client, for example, who wants to hire a chief revenue officer, and they were hoping to be able to have some great women apply for this role. Chief Revenue Officer is a brand new title. It hasn't been on the market for very long. The odds that people have performed that role in the past are pretty small. So certainly the odds that a woman has had that title and is now looking to take her next job, again, very low. So by doing things like paying attention to what the job title is, it's more important for this organization to hire the type of characteristics, experience that they're looking for than it is to attract somebody to apply to that title. So be thoughtful about the title. The opening paragraph, stating right at the beginning that you are looking to hire diverse find diverse candidates, and inviting anybody who has any of the elements to apply will certainly play a long role. And I've done this in my own organization where I started to put this emphasis at the beginning, and all of a sudden I had a very diverse applicant base. It may be more resumes to go through, but that's not a problem. That's a good thing to have. The other thing is ensuring that you have parity when it comes to the interview process. So don't begin your interviews unless you have, and let's again with gender, if you're trying to make some bold moves, then make sure you've got as many interviews with women as you do with men. So if you're planning to interview 5 men, interview 5 women. And that will definitely help stack the odds that you hire a woman or, a person of color, of any visible minority background. Don't complete your interviewing process unless you have a minority that you have interviewed. So it just forces you to think really strong about who your job posting is getting in front of and how you're attracting. Then the next thing is also making sure that what's your website look like? Are these people going to feel like they belong when they look at your website? I've been telling people right now, you may want to take down your management team photos. If you want to look diverse and right now you have no diversity, then maybe don't highlight it. Just, you know, replace it with the words of what you're trying to become.
Some great tips there for sure. In terms of, so you talk about management teams. Sometimes management teams, especially if they're in a startup, they may not know, everything, right?
Mhm.
Um,
Mhm.
do you run into, business owners where they're trying to do their financial plans, but they just won't admit that they just don't know how to do it, or
Yeah, you know what? I got to say that's less and less now because people like call us and they need help, and those are the people that are admitting it. But sometimes I get referrals where somebody will say, "I was told to give you a call. Why don't you pitch me on what you can do for me?" That's usually a bit of a flag that this individual kind of feels they know it all. And I one memory that always comes to mind, I was in a meeting with a banker. I had a client, they didn't feel they needed me in this meeting, but I insisted on going. I said, "Oh, I'm just, let me come. Like, it'll be good."
yeah,
This person was really underestimating the conversation. They didn't understand what the banker was asking. They couldn't speak the same language. And really, they were doing themselves a disservice. They didn't even realize. So I know the value I provided in that meeting. A famous quote they said was, "It's all about the profit on the balance sheet, isn't it?" And they inserted the name of the banker in that. And if anybody knows anything about financial statements, the profit is not on the balance sheet. So right then and there, it is best to finance is one of those areas where most business owners, this analogy was given to me by somebody at one point. They said when a CEO looks around their company, they often feel like they can do everybody's job. By the time you get to a certain size, you feel like you can do most of the areas, with the exception of the finance. That is the one area where the confidence tends to be down. It's just you don't need to learn it. I don't know how my plumbing works in my house. I just need to know how to call a plumber and when to call a plumber. Use the financial experts, and it's complex actually in finance. It's not just one. There's a whole suite of us here. So you need your year-end accountant. You need tax accountant, and you need somebody to audit your financial statements. And those are the voids that the accounting firms fill. You need a good accountant. You should enjoy your conversation with them. You should want to be talking about your planning because it can give you great tax strategies. And then inside your organization, what we do at Number Crunch is we provide all three elements of CFO, controller, and bookkeeper. You always need good foundational bookkeeping because nobody can run analytical reports on your numbers if they're not being captured in a way where the data is easily worked with. And there's, generally speaking, there's a lot of bookkeepers, self-taught, that are serving the business community, but they're not collecting data in a way that analysts can work with it. Your controllers are the ones that are providing that analysis. So if you're in business and over the years, your margins have gone down, you're wondering why your revenues are up and your cash is down, then a great controller can pull apart all that data and make it very obvious to you what's working and what's not. And then your CFO is your strategist. They're helping you figure out that pricing strategy, your growth plan, when to involve the banks, how to leverage non-dilutive capital as well as investor money. And so it's a team, but you don't need full-time people in any of those roles until you hit a large threshold. Most companies under 20 million can handle all of their financial needs with fragmented services. So I think that's a big piece of information that's helpful for all business owners to know if they've had an experience where, well, I had a bookkeeper, but they weren't able to do my pricing for me. Well, yeah, no wonder. It's not what they do. Like you go to the doctor, you don't get your tonsils removed by your podiatrist. It's specialties.
You've had some great analogies today. I think my favorite one was your first one. I think you said missing the exit
Yeah.
because I do that all the time.
Yeah.
So my wife
It's like-
always yells at me.
It's like, I meant the next one. The next
Yeah.
one has the ice cream stop at it. That's why I missed
Yeah.
that one.
Yeah, so, you talked about working with accounting firms as well.
Yes, yes,
In your business, you've worked with, let's say, a number of, I don't know, probably
yes.
every accounting firm in the city?
I don't know, a lot
A lot of
anyway.
them?
Yeah.
So what, do you have any tips for business owners, say for 2021, they're looking at evaluating their accounting firm
Yeah.
or evaluating different options for an accounting firm. Do you have any tips, on doing that?
For sure. I think so. If you're not enjoying your conversations with your accountant, or they're never happening, then there's an indicator that you should consider switching firms. I think it's important a few things. First of all, a strong relationship. So personality is key. Accountants come in all different personalities, as do entrepreneurs, and sometimes it's a great match, and sometimes it's not. And I feel bad when I see these relationships that don't. It's just not a good match, personality wise, and sometimes business owners feel down after talking to their accountant, and that is never a good sign. So one that makes you feel strong and empowered, and you feel like, you know what, you got me, you're in my back pocket as my business experience is different, like as I grow into the US, and you're there to help me understand the retail sales tax and when I need to start filing taxes with the IRS and that sort of thing. So um, that segues into the industry. If you want your accountant and your banker both to have a portfolio of customers that are in the same type of business that you're in, so they know your business model, they understand how it works, so they're bringing relevant comments and suggestions to the table. If your accountant serves all the bricks and mortar business and you're a tech company, it's not going to be a fit. Doesn't matter if they're a family friend, they're not going to bring strong value to your organization. So understanding, and as you grow, that firm will change. We've got great firms of all sizes here in Ottawa. So there's definitely many options good options to choose from. The third area is the networking benefits. So these accounting firms are dealing with a lot of businesses. There's a good chance they're dealing with your target market, or that there's some firm here that's dealing with the customer base that you actually want to sell into, or they're allies. So they are dealing with organizations that are selling into the same market that you are. And that business development advantage can set apart one firm from another. And so I encourage clients to consider the business development side and how much business their accounting firm has brought them over the years. And if the answer is none, then I can tell you that there are some accounting firms that do a great job connecting clients with other value-based firms. So those would be some key things. From a cost standpoint, people think accountants are expensive. A cheap one, I tell you, is a lot more expensive. That's what I'll say. And basically, the rates are fairly standardized across the market. So I will comment that I do find some firms are better at staying with the price that they quote. So you can always ask for a quote for whatever initiative you're undertaking. There are a few in the market that will do change requests. So I would ask about that. Like, in the event that this takes longer, what are you going to do about it? So that you keep your budget in play. But overall, I wouldn't scrimp on the accounting firm or your lawyer.
Yeah.
Costs you a lot more in the long haul.
Yeah, I totally agree with that. Um,
Bookkeepers too. Oh my goodness. The bookkeeping cleanup is expensive. We do a lot of cleanups for companies that we're trying to save money for years. And so it's just better to pay a decent rate all the way along. And then you'll save yourself headache and ulcers.
I've had that experience. When I first started as an entrepreneur, first couple of years, we had a bookkeeper suggested by an organization that provided us a loan.
Okay. Yep.
So we used this bookkeeper and thought she was great.
Uh-huh.
She was doing my stuff.
Yeah.
And then we ended up getting audited, and they were just laughing at what was being done with our financials and our records, and we ended up owing a ton of money after that audit. So yeah, I can tell.
I feel for you, because you know
Yeah.
what? You just actually touched on something that's so common. Bookkeeper personality can keep them in play for a long time. So people love their bookkeepers. If the ones, that are really compassionate and they'll check on your kids but you don't know if they're actually doing a decent job until you find yourself in one of those binds. And then, oh my goodness. So, at any point, we're happy to take a look at people's bookkeeping. I used to think it was just chronically bad everywhere. Luckily, I've been doing this long enough now that I pleasantly surprised periodically as well. But if anybody's ever looking for an assessment of like, how is my bookkeeper doing? Happy to take a look. It's really easy for us to do that kind of review, and we'll let you know if you're headed for
Yeah.
a mountain.
Oh, that's great. So sliding back to 2021,
Yes.
into, I guess, kind of get some final thoughts and comments from you. What do you expect to see in 2021?
Uncertainty. That's the key word. A lot more of okay, okay. That was the word of 2020. I found that's my calibration word as people hit with surprises and twists and turns, and businesses are forced to shut down and then open, and then I think we're going to have a lot more calibration of that. I can't wait for the cure for this COVID-19 virus to hit the market, because that's going to obviously be a game changer. But until it is readily available to all, we are going to be in this ebb and flow. So I think, and people, I think it's important for everybody to take into consideration that when you look at your business, you're looking at through the eyes of your person. So it's your personal experience first that's coloring everything you look at, including your business performance. Reminding yourself, first of all, having that plan so that you can feel confident that as long as you just one foot in the other, like as you're driving down the road, the GPS says I can just turn up here. I'm not going to question that too much because I'm not in the state of mind today to question things because my kid's school has just been shut down indefinitely. So I'm just going to stick to my plan. That's the kind of mindset for 2021. Have a plan, follow it. Be ready to be ready. And you know what? Keep eyes open for opportunities. There are great opportunities that have been happening in 2020. I know a lot of businesses that have really flourished as a result of taking advantage of opportunities. And 2021 will be even more so. So all of a sudden, unfortunately, there's going to be certain real estate that becomes available. People could grab that. You might have had a vision of where your business could grow to next. And now all of a sudden you can execute on that. There's going to be a lot happening. So make sure your books are up to date. You're ready for deals to happen. There's going to be an increase in M&A activity. It's going to be uncertain times. Your plan will have to have, be ready to be iterated. You'll have many plans before the end of 2021.
Yeah. Well, that's great. I just want to say thank you. I think it was a great conversation with you today, and I think the listeners got some really good information.
Well, thank
So
you, Kyle.
thank
This
you
was
very much.
fun.
Yeah.